Of everything a business owns, one asset is a thief's absolute favorite: cash. It's easy to hide, easy to move, and it's everywhere. So, in this finale of our cash chapter, we bolt real internal controls onto the money, coming in and going out, so every single dollar stays honest. Let's lock it down. So why does cash get special treatment? 3 reasons. First, cash is instantly convertible. A stolen 20 spends exactly like your 20, no questions asked. Second, the sheer volume. A busy store runs thousands of tiny cash transactions a day, and errors and theft hide easily in that flood. And third, all of that makes cash the single most tempting target in the whole business. So we take the 6 controls from part 4 and bolt them straight onto the money. Here's how the 6 controls guard cash coming in. Responsibility. Only trained cashiers ever touch the receipts. Segregation. The person who takes the cash is never the person who records it. Documentation. Every sale leaves a trail, a register tape, or a remittance slip. Physical controls. Registers up front and a safe in the back. Verification. A supervisor counts, and the treasurer checks the deposit against the bank. And people bond them, rotate them, screen them. 6 controls. One job: protect the cash the moment it arrives. Let's watch a single sale move through a real store. The clerk rings the sale and counts the drawer, but never sees the register tape. The supervisor pulls that locked tape and sends it to accounting, but never touches the cash. The cashier counts the money and makes the deposit, and accounting matches the tape to the deposit slip. See the beauty of it? Whoever holds the cash never holds the record, and whoever holds the record never holds the cash. Nobody can steal and cover it up alone. But drawers don't always balance, and that's completely normal. At a little coffee shop, the register tape says $842.50. The cashier counts the drawer and finds $838 even. That's $4.50 short, probably wrong change handed back during the rush. So we record the cash we actually have, $838. We credit sales for what the register rang, $842.50. And the $450 gap lands in an account called cash over and short. Short is a tiny expense, over is a tiny gain. Keep it small and never ignore a big one. Quick drill. The register tape says $500. You count the drawer and find $506. Over or short? And which way does it go? Pause here and try it yourself. Ready? You've got $6 more than the tape, so that's an overage, a tiny gain, miscellaneous revenue. Count more than the tape, you're over. Count less, you're short. Easy. Not all cash walks in the front door. Some of it arrives as checks in the mail. The rule here: open the mail with at least 2 clerks together, never one person alone. Each check gets stamped for deposit only the second it's opened, so nobody can run off and cash it. And the clerk write up a list of every check. In triplicate, 1 copy travels with the money, 1 goes to accounting, and 1 stays put. 2 sets of eyes means a thief would need a partner, and partners are risky. Now let's flip it around. Cash going out. Here's the golden rule for paying it out. Whenever you possibly can, pay by check or electronic transfer, never with loose cash. Why? A check and an electronic payment both leave a permanent paper trail, a name, a date, an amount, all traceable. The only exception is the tiny stuff, and that's exactly what petty cash is for, which we covered way back in part 1. Same 6 controls, now guarding cash going out. Responsibility: only the treasurer signs the checks. Segregation: the person who approves a bill is never the person who signs the check, who is never the person who records it. Documentation: pre-numbered checks, an approved invoice behind everyone, and stamp it paid so it can't sneak through twice. Physical blank checks locked in a safe, amounts printed by machine so nobody can alter them. Verification: match every check to its invoice and reconcile the bank every month. And people, same as always, bond, rotate, and screen. Bigger companies add one more layer: the voucher system. Think of it like a work expense report. You cannot just grab cash from the drawer. The payment has to pass through several independent hands. First, a manager authorizes the cost. Then someone builds a voucher, a packet that gathers 3 documents that all have to agree: the purchase order, the vendor invoice, and the receiving report. Accountants call that a 3-way match, and it proves you actually ordered it, received it, and were billed the right amount. A different person then logs that packet in the voucher register and gives it a pre-numbered voucher number. Only then, on the due date, does the treasurer cut the check, which is recorded in the check register, and the voucher gets stamped paid so it can never be used twice. The whole point? No single person can push a payment through alone. It has to pass through other hands. Slower? A little. Much harder to cheat? Absolutely. One more, and it's the modern favorite, electronic funds transfer. The money moves bank to bank, digitally. Why is that safer? There's no paper check sitting around to steal, forge, or white out. Fewer hands ever touch it, and every transfer is logged automatically. It's faster, it's cheaper, and honestly, it's a lot harder to mess with than paper. Final drill. Name the missing cash control. 1. A single mail clerk opens the mail alone and pockets a check. 2. The same employee approves the invoice and signs the check. 3. Blank checks sit in an unlocked drawer. Pause here and try it yourself. Here's the answer. Number 1. Use 2 mail clerks. That's segregation plus people controls. Number 2. Split approving from signing. Segregation of duties. Number 3. Lock those checks in a safe physical controls. 3 for 3. You've basically earned a cash handling black belt now. Screenshot time. Here's your whole cash control cheat card on one screen. Cash coming in, separate the cash from the records, and follow the clerk, supervisor, cashier, accounting flow. Cash going out, pay by check or transfer, pre-number and stamp paid, and split approved from sign from record. Plus the over and short rule. It's all right here, so save it. And that's a wrap on Chapter 8, Cash. Look how far you've come. Part 1, Petty Cash. Part 2, Bank Reconciliation. Part 3, What counts as cash? Part 4, Fraud and internal control. And now, locking down cash coming in and going out. You can genuinely protect a company's money now, and that is a real, hireable skill. If this course is helping you, smash that like button and subscribe so the next chapter lands right in your feed, and grab the free exercises and notes at appliedanalyst.com. I'll see you in the next chapter.